Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. Billions in Bitcoin seized by US authorities. Over 94,000 BTC from the 2016 Bitfinex hack are found in the hands of some peculiar people. Who will get to keep it? Corporate crypto adoption. BlackRock plans its crypto entry. Tesla continues to hodl. KPMG adds crypto to its portfolio, and McDonald's reveals its metaverse patents. Why Wells Fargo says we're still early. Crazy crypto cash. Polygon, Alio, Alchemy, and Animoca brands collectively raise over $1 billion in a week. What does this mean for the crypto industry? Play to earn economics. Axie Infinity adjusts SLP issuance to ensure the game endures. Could this be a way to test monetary policy in a decentralized manner? US dollar in the gutter. Inflation hits another record high as consumer debt hits record levels. How Bitcoin fixes this. The drive for decentralization. Tallycoin raises BTC for truckers. Assange DAO raises $50 million for a legal defense. And Aave releases a decentralized social media platform. Is this the beginning of the end for centralized censorship? Regulation retaliation. Crypto companies accelerate lobbying efforts ahead of the midterm elections. Will it be enough to prevent a crypto crackdown? And a closer look at what comes next in this week's crypto market forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. Last week, the United States Department of Justice announced that it had recovered $3.6 billion worth of BTC that had been stolen from the Bitfinex cryptocurrency exchange in 2016. The BTC was found to be in the possession of two peculiar people in New York City, who were subsequently charged with laundering the stolen coins. As I mentioned in my recent video about the dark side of NFTs, money laundering involves making the proceeds from illicit activities look legit using, say, a business that accepts lots of cash as payment. What's odd is that the couple who allegedly conspired to launder the stolen BTC put their personalities on full public display, while simultaneously using sophisticated techniques to hide their BTC sales. What makes this even more odd is that the couple kept the private keys to their BTC stash on a cloud drive connected to the internet, such as Google Drive. This is eerily like the amateur error made by the hackers behind the Colonial Pipeline attack last year, who likewise put the private keys to the wallet holding their stolen BTC on Google Drive, making it possible for US authorities to recover the funds shortly after the ransom was paid. The recovery of Bitfinex's BTC has consequently raised a lot of eyebrows in the crypto community, especially since the couple have not been charged with being behind the Bitfinex hack itself. The bigger question is what will happen to the over 94,000 BTC that's currently being held by US authorities, given that it rightfully belongs to Bitfinex. As many have pointed out, the contentious relationship between US regulators and USDT issuer Tether means that Bitfinex may struggle to get it back, since Bitfinex is effectively Tether's sister company. Others have pointed out that it's possible that US authorities will try to return the BTC directly to those affected by the Bitfinex hack in 2016, though it's unclear how exactly this would be coordinated without Bitfinex's help. The third possibility is that US authorities will simply opt to auction off the recovered BTC to wealthy individual and institutional investors the same way they did with BTC seized in the past. This would be the ideal scenario for BlackRock, given that the asset manager is reportedly looking to offer crypto investing to its clients with direct exposure to the underlying assets. For those unfamiliar, BlackRock is the biggest asset manager in the world, with over $10 trillion in assets under management. This includes hundreds of millions of dollars in crypto mining companies via its ETFs and a more than 16% stake in MicroStrategy, which itself owns over 125,000 BTC worth $5.3 billion. BlackRock insiders did not provide dates on when the asset manager will offer these services, but according to sources, the company is looking to integrate this crypto trading functionality in its Aladdin institutional software. I talked about the significance of this in a Telegram post recently, which I'll leave in the description for you. Speaking of adoption, in a relief to crypto holders, Tesla's recently released SEC filings for 2021 revealed that the company had not sold any BTC besides the small amount that had been sold at the start of the year to, quote, prove liquidity. Some have taken this as a sign that the crypto market has yet to reach the top of its current bull cycle, since Tesla would have otherwise sold some or all of its holdings. Tesla's BTC treasury has inspired other publicly listed companies to add BTC to their balance sheets, and the latest one to join the list is KPMG, one of the big four accounting firms. In a statement, KPMG's Canadian arm explained that it had added BTC and ETH to the corporate treasury because it sees cryptocurrency as a, quote, maturing asset class. KPMG's crypto acquisition is significant because the company is committed to ESG and has even been working to standardize ESG scores with the help of other accounting firms. As I mentioned in my video about CoinShares' Bitcoin mining report, ESG concerns are one of the only things standing between institutional investors and cryptocurrency. KPMG's move, therefore, sends a sign to ESG-oriented investors that they can invest in cryptocurrency without violating their commitments to ESG criteria. Meanwhile, McDonald's has filed for 10 metaverse patents in the United States, which include things like virtual McDonald's restaurants with real-life home delivery, the sale of virtual food as NFTs, and even virtual events. It's not currently known whether McDonald's will opt to create its own metaverse or buy land in an existing one, but its real-world operations suggest it may in fact buy up existing virtual land. This is because McDonald's owns the land its real-world restaurants are built on, and that technically makes it one of the largest real estate companies in the world. Now, in the middle of all this corporate crypto copying, Wells Fargo released a crypto report which argues that we're still in the early days of cryptocurrency. If you're wondering just how early we are, this chart presented by the bank basically sums it up. Cryptocurrency is where the internet was in the 1990s. Further proof of crypto's early-stage status can be found in the incredible amount of capital being piled into the industry almost every week. For example, Polygon recently raised $450 million from various venture capital firms inside and outside of the crypto space, as well as wealthy individual investors such as Kevin O'Leary. In addition to further legitimizing Polygon as a project, it proves that there is a lot of demand for Ethereum scaling solutions, even with Ethereum 2.0 around the corner. According to Polygon co-founder Sandeep Nailwal, Ethereum 2.0 will only increase Ethereum's transaction speed from 15 TPS to 20 TPS, meaning Layer 2s will be required until shard chains are introduced. Even then, it's likely that Ethereum will continue to require Layer 2s due to high demand. Another crypto project called Alio also recently raised $200 million from various VCs. What's interesting is that Alio's focus is privacy, and privacy has recently been a contentious topic in crypto for regulatory reasons. Recent raises by other privacy-oriented crypto projects such as Secret Network suggest individuals and institutions are pushing for privacy, which is certainly a good sign. There's also been a push to improve developer tooling in cryptocurrency, and this is something Alchemy has been doing since 2017. Like Alio, Alchemy recently raised $200 million, bringing the company's total valuation to a staggering $10.2 billion and the contents of its coffers to over $500 million. This is about the same amount Animoca Brands is expected to raise in an upcoming funding round, which would bring its valuation to a modest $5 billion. If you watched my video about the sandbox, you'll know that Animoca Brands is the company behind that project, as well as a handful of other metaverse worlds and play-to-earn games. Speaking of play-to-earn games, Axie Infinity recently adjusted the tokenomics of SLP to prevent its economy from imploding. For context, Smooth Love Potion, or SLP, is a crypto token earned by Axie Infinity players, and it's required to breed its in-game avatars, which are known as Axies. Any SLP used for breeding is burned. Now, until recently, SLP minting was outpacing SLP burning by a factor of 4. This flood of SLP supply caused its price to crash in the absence of demand from breeders. In turn, this caused Axie Infinity players to leave for greener pastures since their play-to-earn profits were cut, resulting in the first decline in user activity since the game's release. The Axie Infinity team noticed this and tweaked SLP's tokenomics to reduce issuance and bring it back in line with the demand coming from Axie breeders. This caused SLP's price to explode, and Axie Infinity user growth is likely to follow on the prospect of renewed play-to-earn profits. As I mentioned in my video about Axie Infinity, its in-game economy is a perfect parallel to the real-world economy because both rely on constant growth. Whereas central banks control the issuance of money, the Axie Infinity team controls the issuance of SLP, and this makes it the perfect sandbox to test monetary theories. The thing is that many people around the world currently rely on Axie Infinity for income because of the pandemic, and this means any economic experimentation can have very real economic consequences. Funnily enough, Axie Infinity has proven yet again that cryptocurrency projects are more responsible with monetary policy than central banks, which continue to print fiat currencies at the expense of the average person. Case in point, in the United States, inflation is now running hot at 7.5%, the highest in over 40 years. If you watch my video about how the CPI is measured, you'll know that official inflation statistics are misleading to say the least. Unofficial inflation statistics suggest that inflation is running even hotter at 15%, and by unofficial, I mean the 1980s CPI measurement. This inflation is due to a combination of money printing by the Federal Reserve in response to pandemic restrictions, as well as supply chain problems caused by pandemic restrictions. Notice a pattern. This inflation, combined with low interest rates, has incentivized consumers in the United States to borrow more than ever before, causing consumer debt to reach over $15 trillion in 2021. This is bad news because the Federal Reserve is expected to begin raising interest rates in the coming weeks in an attempt to tame inflation. This means this $15 trillion of debt is going to become a lot more expensive to pay off, and we could even see some individuals and institutions start to default on debt payments they can't afford. If that happens, assets will be sold to cover the costs of servicing that debt, and this will lead to a market crash across the board. History suggests that the Federal Reserve will reverse course and reduce interest rates when the markets start to collapse, but doing so would result in even more borrowing and therefore more inflation. Put simply, it's not looking good for fiat, and this leaves only two solutions: a central bank digital currency, which puts governments in total control of monetary policy, or cryptocurrencies with immutable monetary policies built into their code. Current trends suggest that crypto is where people are increasingly placing their bets, particularly BTC, which was built as a response to the same reckless monetary policies we're seeing today. BTC doesn't just make it possible to protect your purchasing power either. It's an unstoppable currency. The importance of this value proposition is becoming more apparent by the day as centralized entities crack down on funds being sent to truckers currently protesting pandemic restrictions in Canada.